Welcome to the deep dive. Today, we're tackling a really interesting bit of financial reporting, related parties.
hmm
Think of it as understanding those connections behind the scenes. The relationships that aren't always obvious, but can definitely influence a company's financial dealings.
Exactly right. And our mission today really is to unpack what related party disclosures look like under the two big accounting frameworks. That's IFRS and US GAAP.
Yeah, international financial reporting standards and U.S. generally accepted accounting principles.
We've got some specific comparison materials here, and we'll dig into where they align and, maybe more importantly, where they diverge.
And why should you, our listener, care about this? Well, honestly, whether you're deep into analyzing financial statements, maybe for investments, or just trying to understand how companies really work.
Or even just following business news.
Right. Understanding these rules is pretty valuable. It shines a light on potential influences, gives you a fuller sense of corporate transparency, that sort of thing.
It really does.
Okay, so let's get started. What's the fundamental definition? What is related party according to these standards?
Well, at the basic level, both IFRS and US GAAP, they generally agree. We're talking about parties that have control over an entity, direct or indirect,
Okay, control.
or joint control, or significant influence. It's cast quite wide to catch various relationships.
So not just outright ownership, but also the power to influence decisions. Got it. But where do we start seeing some daylight between IFRS and US GAAP in these definitions?
Okay. One interesting point is how they treat entities under the significant influence of the same third party.
Okay.
Under US GAAP, well, in certain situations, these entities could be considered related to each other.
Just because they share an influencer?
Potentially, yes.
Yeah.
IFRS, though, doesn't generally make that leap automatically. It's less likely to classify them as related just based on that shared significant influence.
So US GAAP might see a related party link there where IFRS wouldn't necessarily.
That's a fair way to put it. US GAAP seems a bit more focused on the potential power dynamics stemming from that influence, even if it's indirect between the two entities. IFRS leans more towards actual control or the ability to direct activities.
Interesting nuance. Okay. What about the people actually running the show? The executives, the board members?
Oh, absolutely key. Both frameworks definitely identify key management personnel and their close family members. That's important too as related parties.
Makes sense. But how they define key management, is it identical?
Not quite identical in wording, though maybe in practice. IFRS uses the term key management personnel, KMP, and describes them as, having the authority and responsibility for planning, directing, controlling the entity.
So the top decision makers.
Pretty much.
Yeah.
US GAAP tends to use the term management and often gives a more specific list: board members, CEO, CO, CFO, those sorts of roles involved in policymaking.
But the end result is likely capturing the same group of individuals.
In most cases, yes. The practical outcome, who actually gets identified, is probably very similar.
Okay. Now, what about significant shareholders? People who own a big chunk but aren't necessarily managing the day-to-day.
Another clear difference here.
Ugh.
US GAAP explicitly calls out principal owners.
Principal owners.
Yeah, defined as those holding more than 10% of the voting interests. They are considered related parties under US GAAP.
Automatically, just based on that 10% threshold.
Yep. But under IFRS, there's no such explicit rule based purely on a percentage like 10%.
Huh. So IFRS looks more at the actual influence or control, not just the ownership stake.
Exactly. It reflects that slightly different emphasis we talked about. US GAAP flags significant ownership itself as a potential source of influence, while IFRS keeps the focus more squarely on the ability to direct or significantly sway the entity's actions.
Okay, that's clear. And one thing you mentioned earlier, it's not just companies, right? Individuals can be related parties, too.
Absolutely. Both frameworks are clear that the definition covers both legal entities and individuals if they meet those control, joint control, or significant influence criteria.
Good reminder. And what about, say, subsidiaries of related companies? Like if an associate company has its own subsidiary?
Consistent ground there.
Mm.
Both IFRS and US GAAP agree that subsidiaries of associates and joint ventures are indeed related parties to the main reporting entity.
Yeah.
It recognizes that influence network.
Right, the web of connections. Now, you mentioned a subtle point earlier about entities controlled by key management. IFRS says they're related, but US GAAP needs a facts and circumstances check.
Yes, exactly. IFRS is quite direct. If key management personnel or their close family control or jointly control another entity, that entity is related. period.
Okay.
US GAAP introduces this facts and circumstances analysis. So you'd look at the specifics, what's the nature of the manager's link to that other entity, how much influence do they really have, are there significant transactions?
So a bit more judgment involved under US GAAP.
A bit more judgment, yes. But as the guidance suggests, it's not expected to lead to massively different outcomes in practice most of the time. It's more about the process of getting there.
Okay. One last definition point. Employee benefit plans, like pension funds.
Yes, both frameworks treat post-employment benefit plans for the company's employees or employees of its related parties as related parties themselves.
Even the plan itself is related.
Correct. And interestingly, this also includes multi-employer plans, even if the company doesn't control or significantly influence that specific plan.
Wow. Okay. That's a pretty wide net. So once we've identified all these potential related parties, how do we account for transactions between them? Are there special rules?
Generally, no. That might surprise some people. Neither IFRS nor US GAAP usually dictates special recognition or measurement rules just because a transaction is with a related party.
So you account for it like any other transaction?
Typically, yes, you'd apply the standard accounting principles relevant to that type of transaction, revenue recognition, lease accounting, whatever it might be.
Okay, that seems straightforward, but I feel a but coming.
Well, there is a bit of a but, particularly with US GAAP. While the general principle holds, US GAAP does have some more specific guidance in certain areas.
Like?
Leases are one example mentioned. And also, SEC literature provides further interpretations for U.S. public companies. So, this more detailed guidance could potentially lead to some practical differences compared to IFRS, where the principles might be stated more broadly for certain transactions.
Gotcha. So same basic idea, but US GAAP sometimes drills down with more specific instructions. Let's switch to disclosure then. What needs to be revealed about these relationships, even if nothing actually happened between the parties in a given period?
Big difference here. Under IFRS, you must disclose the relationship between a parent and its subsidiaries. Full stop.
Even if they didn't transact at all that year?
Even then, the logic is that the control relationship itself is significant information for users of financial statements.
Okay, IFRS requires disclosing the structure. What about US GAAP?
US GAAP does not have that specific requirement to disclose parent-subsidiary links just because they exist if there were no transactions.
Really?
However, US GAAP does require disclosure if you have entities under common ownership or common management control, and that control relationship could significantly affect the company's operating results or financial position.
Ah, so it's about the potential impact of the control.
Exactly. You need to disclose the nature of that control relationship, even if no transactions occurred, if that potential impact exists. IFRS doesn't quite frame it that way. It focuses more on the direct parent sublink disclosure.
Fascinating. IFRS disclosed the structure. US GAAP disclosed control if it could have a big impact. What about when transactions do occur?
Here, they're much more aligned. Both IFRS and US GAAP are very clear. You absolutely have to disclose related party transactions.
Any transfer of resources, services, obligations.
Yep, all of it. And crucially, disclosure is required whether or not a price was actually charged.
Because the terms might not be normal.
Precisely. The transaction might be at zero cost, or way below market, or way above. Disclosure brings that to light.
Makes sense. What kind of details do they need to disclose about these transactions? Let's start with IFRS.
IFRS gets quite detailed. You need the nature of the related party relationship, obviously, then the nature of the transaction itself, the amount of the transaction, any outstanding balances at year-end, including the terms, conditions, whether they're secured, things like that.
Right.
Also, the nature of the consideration that's going to settle the balance, details of any guarantees given or received, and, interestingly, any allowance for doubtful debts related specifically to those related party balances.
Wow, that's specific. Doubtful debts on related party receivables. And any write-offs, too.
And any write-offs during the period related to those balances? Yes. It's pretty comprehensive.
It certainly sounds like it. How does US GAAP compare on the transaction disclosure details? Is it as granular?
US GAAP also demands significant disclosure, but with some differences. For instance, it doesn't explicitly require grouping the disclosures by category of related party, like IFRS implies.
Okay.
And it doesn't specifically mandate disclosing the allowance for doubtful debts related to these transactions, like IFRS does.
Ah, so that doubtful debt piece is an IFRS specialty.
Seems that way. However, US GAAP does require something IFRS doesn't explicitly ask for.
Mm.
Disclosure of any changes in the method used to establish the terms of the related party transactions compared to the prior year.
Oh, that's interesting. So if you start pricing things differently with related parties, you have to call that out under US GAAP.
Exactly. So you see, both want transparency, but they focus on slightly different details.
Right.
IFRS maybe goes deeper on the financial specifics of the balances, while US GAAP adds this focus on changes in how deals are structured.
Very interesting distinction. Okay, let's talk about something everyone loves to scrutinize. Executive pay, management compensation. How does that fit into related party disclosures?
Yes. This is probably one of the most significant divergence points in terms of where the information is disclosed.
How so?
Under IFRS, it's quite clear. Disclosure of key management personnel compensation is required within the financial statements themselves.
Right in the main report.
It's right there. And it needs to show the total amount and also be broken down by category short-term benefits, post-employment benefits, share-based payments, etc.
So very visible under IFRS. What's the US GAAP position?
Under US GAAP, that level of detail on management compensation is generally not required within the audited financial statement.
Not at all.
Not within the statements themselves. Now, hold on. For public companies, SEC registrants, the information is required, but it's disclosed outside the main financial statements.
Where would you find it then?
Typically in things like the annual proxy statement filed with the SEC. So the info is public for those companies, but is not part of the core GAAP financial statements package in the same way it is under IFRS.
That's a fundamental difference in presentation philosophy, really. Information location matters.
Sure.
Okay, what about government-related entities? Any special rules for them?
Yes, another difference here. IFRS provides what it calls a partial exemption for government-related entities
An exemption from what?
from some of the detailed disclosure requirements, specifically for transactions they have with the government itself or with other entities also controlled by the same government.
Why the exemption?
Likely acknowledges the unique position of these entities, the sheer volume of potential transactions, and maybe avoids disclosing operationally sensitive stuff. They still need to disclose significant transactions, just perhaps with less granularity than for other related parties.
Okay, so IFRS gives them a bit of a break on the details. Does US GAAP do the same?
Yep. US GAAP does not offer this partial exemption. If a government-related entity is reporting under US GAAP, the standard related party disclosure rules apply in full.
No special treatment.
No special treatment under GAAP itself. But, as we noted earlier, many U.S. government entities actually follow specific governmental accounting standards, not corporate U.S. GAAP. So the practical impact might vary depending on which set of rules they follow.
Right, that's a key practical point. Okay, almost there. Presentation. When you look at the actual balance sheet or income statement, do related party amounts have to be shown separately?
Under IFRS, there are no specific rules requiring separate line items for related party transactions on the face of the primary financial statements. The detail is expected in the notes.
So potentially buried in other line items like revenue or receivables?
Could be, yes.
Oh,
The notes are where IFRS expects the elimination.
And US GAAP, especially for those SEC companies.
For SEC registrants using US GAAP, the answer is different. The SEC does require related party transactions to be presented separately on the face of the balance sheet, income statement, and statement of cash flows if they are material.
So much more prominent display under US GAAP for public companies in the US.
Definitely. The aim is higher visibility right there in the main statements.
Okay, just a couple of wrapping up points. Can companies lump similar small transactions together in the notes?
Yes, both frameworks allow that. You can
Oh.
aggregate similar items as long as doing so doesn't hide or obscure any individually significant transactions. It's about balancing clarity and conciseness.
Makes sense. And what if a company says, hey, these deals with our subsidiary were totally arm's length, just like we do with anyone? Does that get them out of disclosure?
Absolutely not. Under both IFRS and US GAAP, disclosure is required regardless of any claims about the terms being arm's
Well, you
length.
still have to report it.
You still have to report it. And furthermore, if you do make that claim that the transaction was on arm's length terms, you need to be able to back it up. You need to substantiate that claim. Just saying it isn't enough.
Good point. Substantiation is key. Okay, so we've covered a lot of ground comparing IFRS and US GAAP on related parties. What's the big picture takeaway?
I think the main takeaway is that while both systems share the fundamental goal, transparency about potentially influential relationships, they definitely have different ways of getting there. They define related parties slightly differently, especially around influence versus ownership percentage. Their disclosure requirements vary quite a bit in terms of detail, location like management pay, and specific items like parent-sub relationships or doubtful debts.
And those specific exemptions or requirements, like for government entities or SEC presentation rules.
Exactly. So while the spirit is similar, the letter of the law leads to noticeable differences in the final financial reporting package.
Okay, that's a great summary. So here's something for you, our listener, to chew on. Given these differences, we've discussed the varying levels of detail, where information is presented, what gets automatically disclosed, how might this affect how you compare companies, especially if one uses IFRS and another uses US GAAP.
Yeah, does one system give you perhaps a clearer or maybe just a different kind of insight into those crucial behind-the-scenes relationships?
Which approach do you think ultimately serves transparency better and why? Definitely something worth considering next time you're looking at a set of accounts.